following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I'm back from a little sojourn down in Florida, tanned, rested, and ready for some volatility viewing. And unfortunately, I wasn't joined this time down croquet courtside, try saying that 5 times fast, by my partner in crime, good old Don Schlesinger, but perhaps we'll do it again. But Don, I'm sure you had an equally good time back there in New York, pining away for the croquet courts of Boca.
Well, let me tell you, if there was ever a weekend to do it, it was last weekend because we got socked with snow yet again. So I was all ready to be on the show and talk about the next storm that we were getting, even as we head into the middle of March. But unfortunately, we didn't do that particular show. So weather's a little bit better now, and hopefully the crocuses will be budding soon.
And if Don sounds a little bit different, dear listener, the Skype gods are not smiling upon him today. So we're doing this via the magic of telephone. You may have heard of that wonderful technology from Mr. Alexander Graham Bell. So we'll make do. Maybe we can fix his connection somehow during the show and get him back on the regular way. But for now, we'll make do with the old Skype. And we will also be joined momentarily, dear listeners, by my other co-host, my other partner in crime, good old Mark Sebastian from OptionPit.com. He'll be joining us in just a few minutes, so that's a little tease for you who tune in for Mark. And now, with the team assembled, we're going to dive right into our volatility review segment.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the program where we discuss the week's worth of volatility and volatility trading action and volatility movement in general. And it was another intriguing week, to say the least. And before we even get into that, I should apologize, of course, for last week. We didn't have a Volatility Views. We just couldn't get it together. I was, shall we say, a wee bit under the weather and not up for an hour's worth of volatility talk on the radio. I wasn't up for much at that point, let me just say. So I apologize for if you tune in regularly on Monday mornings looking for that show and it wasn't there. So we'll try to do double the quality this week to make up for it. And speaking of this week, it was indeed an active week, and of course it was an active week last week when it came to volatility and volatility action. Since we didn't have a chance to talk about the previous week's worth of vol action, let's do a more broad and all-encompassing vol review looking back at the last 2 weeks' worth of vol action. And Don, even though you're on the phone, I can still hear that you're champing at the bit here to discuss what's been catching your eye over there in NASDAQ land. So perhaps we'll start there, sir. What over the past 2 weeks really has caught your attention?
Well, obviously, it's been an interesting 2 weeks, and we've been setting nearly record lows insofar as the major indices, numbers that have not been seen in quite some time, and basically NASDAQ, certainly S&P, have not been exempt from that observation. So actual realized volatility currently at levels on the NASDAQ in the mid 11 handle, and that has dropped precipitously from a high of over 14 that we saw just back on March the 5th, which was about 10 days ago and would have encompassed the other show that we might have done last week. Since that time, markets going higher, as everybody knows, inverse correlation even between realized volatility often and market price. And as a result, as we reach record highs on both the Dow and closing in on one for S&P, we are seeing handles in the 11s once again, not only for realized volatility, but as Mark will certainly discuss in a moment, for implied volatilities and for VIX as well. So some interesting times as market commentary talks about never having had a first quarter up as much as we are now without the year being higher in the entire history of the market, records for the Dow, near records for the S&P, of course not quite so for NASDAQ, but in any event, some extremely low volatility, but once again, in relation to what people have been accustomed to over the last year or two, but perhaps this is going to be a lot more the norm as we go forward.
And listeners, we are now joined by none other than good old Mark Sebastian from Option Pit. Mark, how are you doing this fine Friday afternoon?
You know, I'm a little worried that we may have hit the Mila Kunis top.
The Mila Kunis top? Is that somehow to imply that perhaps it looks good, but then underneath perhaps there's something wrong with it fundamentally?
No. Mila Kunis went on TV this morning and said she's rotating out of cash.
I thought that was some Mila. Really? I didn't see that.
Mila Kunis is really buying stocks now.
Well, there we go. Now I have to start loading up to the downside. That's just. If ever there was an indicator in life of certainty, that is probably it.
Yeah. Now, Mark, real interesting trade today. I don't know if you wanted me to wait to get into that.
Go ahead. Let's dive into it now.
Yeah. All right. Well, here's the ES options. So the E-mini futures options. Customer has so far bought just under 87,000 of the June 1550 calls, which is the equivalent of about, let's see, they're 55 deltas. You know, call that 50,000. That's like buying 50,000 minis. Now, against that, we're seeing on the SPX side of the plate, around the 1550s and 1555s, we've seen another, let's see, this is 27, about 55,000 of the June 1550s and 1555 contracts trading. They're trading on both puts and calls. Looks like straddles on the 1550s and straddles on the 1555s. So apparently a big group of somebody with that kind of dough.
Someone with some capital. Wow.
Has either drawn a line in the sand or has traded something big upstairs against this. But that is a volatility line in the sand if I've ever seen one.
That is some substantial vol buying. Wow, that is. I'll have to do some quick math here and to see what the net outlay on that is. But that is substantial.
The guy bought the equivalent of, call it 100,000 E-minis using June vol.
I'm trying to think back, and obviously,
and with the gamma, that net could be double that.
I'm trying to think back, and it's been a while since I stood out in the S, but I'm trying to think of any trades that were even approximate to that size on a straddle or anything like that. And that is
I'm sure
there were a partial, but not straddles. Those don't go up very often like that out there.
No, that's a
naked size straddles like that. That's interesting. That's very interesting. So you're right. That is very much a vol line in the sand. He's saying this far, no farther. and I will make them pay for what they've done.
Yeah, and he's not a believer in the Mila Kunis top.
That's an impressive buy. I need to dive into that a little bit.
It was an incredible option trade.
Now, of course, we've talked a lot on recent shows, Mark. We didn't have a chance last week because we didn't have a show to discuss. But we've toyed on even the show a couple weeks back about how we all kind of thought that, vol was probably going to come off slowly again and drift down. And we toyed with the idea maybe somewhere in the VIX cash realm sometime in the not too far future we would see it dip down into the 12 handle again. But as Don said, we've been trading here in the 11 handle in the VIX cash range for a while now, which I think is just been craziness. I know we're going to get into some of the Contango stuff in a little bit, so we won't dive too deep down that rabbit hole now. But did the speed of our move catch your eye and kind of surprise you a bit?
No, I mean, there was one day where the VIX really did take some heat, but it's not like the VIX has been dropped. It went from 15 to 12, 11 and a half in 2 days. It took it to, basically it took from the last time we talked to now to get to 11 and a half. And if you look at, as Don would say, realized volatility, it's not there. It's really interesting. If you go to volix.us and you look at S&P vol, S&P 21-day vol, the 21-day real vol US 500, 11.27. Now, 10-day vol. So kind of where we've the last, since we started since we chatted, the vol from this vol views to the previous vol views has been right around 5%. So there's how we get our low VIX.
Yeah, it's funny. It's just been interesting stuff to watch over this past few weeks. And you're right, it wasn't too precipitous. We had that one kind of day where it really kind of aggressively got clipped. Then the rest of it has kind of been the meandering move we tend to expect in these sorts of upward movement days. Of course, if you factor it back a little bit farther to the VIX/vol squeeze of a few weeks back, then we've had an even more precipitous drop off. If you want to include that one kind of crazy data point in the calculation, then we've had the move in the cash at least from the 19 handle all the way down to this range.
And, of course, yet again, the comment to make is the VIX itself is trading at levels that are identical to the S&P realized vol. Once again, the short-term 5-day, as Mark mentions, is much lower still, but 21-day trailing historical or realized volatility, 11.3, and VIX, if you will, supposedly a forecast of future volatility that normally includes some sort of a risk premium, 3, 4, 5 points above realized, is actually trading at exactly the same level. Now, of course, that's the cash index. That's not the futures products. But again, the concept being that options implieds are now trading with absolutely no spread to the trailing S&P historical 11.3 realized volatility.
Yeah, we actually, it's interesting. We were looking at this. That's incredible. I mean, just how in line things have been. Mark, we actually had kind of an interesting debate. And Don, I'd love to hear your thoughts on this. We were looking at this customer and saying, he drew a line in the sand using options. So he bought straddle. So he's got a bunch of gamma and a bunch of vega. And then we had a debate. If you buy a June contract and you want to hedge your vega, all right, are you better off? What's the better hedge? The hedging with the May future or hedging with the June future in VIX if you want to hedge your vega off? So, our theory was that May might actually work better than June.
But then you have all the fun of rolling again in that time period. Of course, you incorporate that when you're doing June anyway, kind of intrinsically.
And our big thing was that May expiration is going to be basically VIX is going to basically be what the June VIX vol you're holding is.
Yeah, well, that, of course, is the concept there. The difference between when you have that expiration, it's really a forecast of a forecast. So, it's really relating to the period that's following. And people who first start the trading can obviously be confused by this. And it's a difference that we've had to take into account when we've done any kind of research and trying to match for spread purposes, real vol and implied vol or VIX, to make sure you're not comparing apples to oranges, because a real vol contract, when you say it expires at the end of May, it expires to the May volatility, to what has happened as real volatility for the month of May. When a VIX contract expires at the end of May, it expires to the
June
forecast
volatility
of what people are forecasting for June.
Right.
So it gets a little complicated.
And that was the big debate we had: is would you rather have May get where the forecast is for June? Because if you really are carrying that June contract, then you end up by 20 days, by 10 days in, messing around with a lot of July.
That's correct. I agree with that.
So our actual thesis was that we would rather, we thought it'd be a cleaner hedge to hedge with May, because really, if you're holding a straddle that you bought in June, you're probably not carrying it into 30 days to expiration anyway. So if you wanted a clean Vega hedge, you might use. We wanted to use the May future.
Now, he's probably not going to carry it to expiration. Of course, the tinfoil hat argument out there would be forget rolls, forget everything else. The VIX settlement process in and of itself is so seemingly arbitrary at this point that perhaps you want to minimize your exposure to the number of settlements you may have to endure. So perhaps you forego May altogether and just do June, and you take it all off together as one big package down the road.
Right, but you don't know. The big issue is you don't know our big argument was, well, that's well and good, but what if there's some event that is in July that is jerking around June July vol that isn't affecting June vol in the same way? Think like a fiscal cliff type event, and you're not getting the clean hedge. So our thought was sell a May future against the June straddle, and then like the Monday or Tuesday before VIX expiration, you'd be unwinding the whole position, and you'd have made or lost money in your gamma, but you and potentially made or lost money on some Vega, depending on the spread.
Yeah, that probably would work for his time horizon. I kind of agree with you. I don't think this guy is probably going to roll this all the way or ride this all the way through till the final moments of June expiration.
I don't know anybody that would buy that many deltas. Let's call it the equivalent of, he basically bought, 100 and some odd thousand. It's like 5 million E-minis he bought. He bought 5 million times the value of the S&P. So I don't think he's carrying that I don't think he really wants to deal with cascading decay.
I'd love to see his risk manager's comments on that trade. It might be interesting on what his holding period will be once the risk manager gets involved.
I think he probably said, here's how much money I have in my trade, back off.
That's an interesting one to mull. I think perhaps we'll keep an eye on that on the open interest, and perhaps on the coming weeks.
The guy that executed that, here's the issue. The guy that executed that trade, the risk manager probably reports to him.
Yeah. Yeah, actually, if you have the capital to throw that kind of stuff around, perhaps the risk manager is slightly lower on the totem pole than you.
Yeah.
That's one of those things. I think we'll definitely have to mark that one down and come back to it in coming weeks and see if and when this guy takes it off, how he proceeds to do it, and then we can perhaps, by doing that and seeing that, we can kind of divine his true intentions of what he's really going for here. But interesting one to watch. Well done, sir. We'll keep an eye on that one. I think with that, we're going to close out the volatility review for this week, and now we're going to roll right on into your portion of the show, the old listener mailbag.
Listener mail. Listeners write in.
Mailbox.
All right, and welcome to the old mailbag. This is, of course, where you, the listener, get your chance to sound off on the old Vol Views program. And first up, we have a question from Phil Fan. I'm guessing he lives in Philadelphia. Just call me go on a wild limb there, wild tangent. He writes, do you ever plan to host a live recording of Volatility Views? If so, when and where? Please put me on the list. Interesting timing to your question there, Phil Fan. Don and I were just kind of discussing this a few weeks ago on some of the potential for doing something like that. If you've been following our episodes and our numbering, we're getting in the realm of episode 100. It might be nice to do something in and around that time frame for this show, perhaps a live recording event or something like that. If we did do that, it probably would be in Chicago. Sorry, Phil fan, it wouldn't be in Philadelphia. But if you can make your way out to Chicago, it might be kind of a fun event. Or who knows, maybe we can find a way to let you beam in remotely from the show. But it's something we're considering. No concrete plans for that. I don't know, Don, if you have anything else you want to add to that. But yeah, so far it's an interesting idea. We're mulling over maybe sometime in the late summer, early fall, doing something to correlate around the time frame of episode 100, but we'll have to see. Don, anything you want to add to that?
No, I think the timing will be interesting. A lot of people are away in the summertime, but as we approach that show, and I tried to count the numbers, I think we're up to about 84 or 5 at the moment. So another 15 could be in the 4-month range. If we take some time off in July, it could push it out a little farther. But in any event, the concept of doing that as we did a while back when we were out in Chicago would be fun.
Of course, if I could keep getting struck low by various flus and whatnot, we might take us a long time to do those last 15 episodes there. All right, next up we have a question from Tim Moore. He writes, the host, meaning me I'm assuming, frequently says that vol traders don't understand basic math. What does he mean by that? And good question, Mr. Tim. That actually is a somewhat half joke that I make on the show on a regular basis. We talk quite a bit about the implied versus realized discrepancy on this show. We also talk about how the fact that the market tends to favor from a volatility perspective, of course, moves to the downside versus moves to the upside, even though both are obviously movement, both are obviously volatility. So when we take those kind of things into account, that's when I tend to joke that the market doesn't really understand basic math, or even like we had a few weeks ago, where we had that sharp, precipitous spike in VIX to the point where, and then of course once we dive in here on the show, we start talking about the actual realized vol that we're seeing in the marketplace. It is clear that those levels of implied volatility are not in any way sustainable over the long term. So that's when I usually trot out that little euphemism, that little saying I like to throw out there, that vol traders tend not to understand basic math, because when you look at the actual math behind it, sometimes it seems like perhaps they do not. Of course, I'm joking. They do, but sometimes it seems like perhaps they do not. All right, next up, we have a question from the perhaps appropriately named, I don't know him, good old X64. I love the handles of our listeners out there. And he writes, this might be a good one for you. You probably want to chime in on this one, Mark. And are there any good tools out there that show up to the minute and even intraday realized volatility? Of course, there are a lot of tools that will show you historical realized vol, 20-day, 50-day, whatever. When you start getting into the more up to date, up to the minute type of realized vol, that's a little bit more of a difficult calculation. Listen to some of our earlier shows where we've done here, where the boys at Volex have told us how difficult it has been to get their real vol contracts to put out some sort of real-time calculations. You can see how difficult that is. But there are some platforms out there that will give some approximation of that. Mr. Mark, what's your favorite amongst those?
I'm not sure there is anything that actually does real-time realized volatility. If you go to our website and you go into the drop-down menu that says Real Vol Formulas, the second one from the top is the Real Vol Real-Time Formula. And it's a rather ominous looking thing, but we actually have a patent pending for it, because it certainly is our intention, once we have our contracts up and trading, to be able to disseminate throughout the day our concept of this real-time realized or historical volatility. And people who want to see what our premise is and how we've actually formulated it can simply go to the website under Real Vol Formulas and pull down the one that's entitled Real Vol Real-Time Formula. There's a write-up of it there. There's an explanation of the math and how we would treat the intraday portion of the new day. But basically, the idea would be to simply have the same kind of 21-day average of realized volatility, but be dropping out as the day goes on, the farthest day, and replacing it with the information from the nearest day on a weighted basis. And you could do it by the second, you could do it by the minute, and the idea would be as the current day goes on, you would simply be dropping more and more of the farthest day in the 21-day calculation, so that you'd always be maintaining a constant 21-day formula where 20 days would be entrenched, but the farthest day would be dropped as the current day runs its course. So we played around with that concept. I think it's a valid one the way we've set it out. Chances are when we are up and trading that we will actually contract this out to someone who will do this kind of a real-time calculation for us. It's kind of server intensive and calculation intensive, and who knows, I'm not a lawyer, but there may even be legal ramifications of our both being the disseminators of the formula itself and the people who are trading and offering the product. So best left to a third or independent party to disseminate the actual intraday index, but that's what the plans are.
Yeah, I don't think there's anyone really out there who can deliver exactly what you're talking about there, Don. Up to the minute. I know there are some that try to approximate it. Off the top of my head, I can't remember their names.
I guess the only one, that's the whole thing is that Garch and some of those are based on close. I mean, something like ATR could maybe work, but you basically have to run something that kind of assumes we're here right now, and that's it,
Yeah.
And actually, what's interesting, just to give you a little background in our discussion with some of the exchanges and some of the traders and some of the market makers, people that we have had discussions with in the past couple of years, they actually sort of, I won't say require, but certainly feel more comfortable and clamor for this kind of an index and this kind of information. And I think it was one of the options exchanges who said, you got to have a real-time index that's disseminated every 15 seconds or so. So, Bob and I got to thinking about how to design such a product. And again, it's not a secret. We've got it out there on our website, and anybody who's interested can take a look, and, we'd be happy to receive any feedback from people who would look at this and say, yeah, I agree with that, or perhaps you could do it this way. But this is our attempt at getting the concept of real time, and it's by constantly monitoring what the intraday price is of the underlying, be it the S&P or whatever, and constantly weighting that more and more for the last day as that last current day proceeds to trade into the afternoon until the close. And then ultimately what would happen would be upon the close at the very, at the witching hour at 4 p.m. New York time, what would happen would be that you would have completed the newest 21st day. It would get all of the weighting for today, and the farthest day, which is now 22, would be dropped completely, and you would have the same type of value for the intraday formula that you have for the interday close-to-close formula at that particular moment, at 4 p.m. New York time. So that's the premise.
Of course, while we're talking here, I'm banging away at the old Live Vol Pro platform. I know it's very retail friendly. A lot of our listeners like that platform. And of course, they have all the various screeners and scanners and things you can do for historical vol and 3-day and 5-day and intraday, not intraday, but daily type. And once you get beyond the daily range, you're right, that is, and the daily close to close, that becomes a much more difficult prospect that no one really seems to have mastered as of yet, for all the reasons that Don just laid out and all the difficulties inherent therein. So yeah, good question there, Mr. or perhaps Mrs. I don't know, X64. It's an interesting one. I know you guys over at VolX are struggling to solve that. So perhaps you check back in a few months, Mr. S64, and see if they've been able to crack that problem. Next up, we have a question from Aston Meyer writing to us out of good old Brooklyn, New York, not too far from your stomping grounds there, Don. And he writes, I enjoyed your recent show with Randy Swan. Well, thank you very much, Mr. Aston. And he says, he goes on to say, but do you really think it is realistic for a client to expect his financial advisor to have a working understanding of volatility in addition to all the other things they keep track of for their clients? He lists stock selection, tax implications, risk tolerance, etc. Thank you for this wonderful program. I have learned quite a bit. Interesting question you have there, Aston. And I think in a nutshell, in short, I do. Because at the end of the day, one of the primary reasons you're going to these people, of course, all the things you list are, of course, very viable. But at the end of the day, one of the primary reasons you're going to someone to manage your money is for the risk management, for the asset allocation portion of their expertise. And if they are going to be indeed your asset allocators, if they are going to manage your risk, then they really can't do that effectively without at least a working basic knowledge of volatility and, of course, options and how to use that to hedge and how to know how these volatility levels impact the prices of the puts they're buying, of the calls they're selling to generate income. If they're going to be your main asset allocator and your risk manager, they really can't do that job effectively without at least some sort of working knowledge of the volatility and how it impacts options and how they should use options to maximize volatility when possible. The other things you mentioned, tax implications, risk tolerance, they should, of course, be conversant in those. And perhaps they could also have a larger practice where they could outsource some of that to other people, or vice versa. Perhaps you go to a planner who has a lot of tax knowledge, but perhaps he's not your main asset allocator. He outsources that to someone else. Whoever that person is, who is your asset allocator and risk manager, they need to have a working knowledge of volatility and options and how those two intertwine, because that really is fundamental to good quality risk management. Don and Mark, I have a feeling you're going to agree with me. Who wants to go first?
Well, I agree with you, and I'd make the following comment. I mean, the question is, do you think it's realistic for a client to expect this? And I think the answer is yes, it is. Whether the advisor actually then fills the bill or not is an entirely different matter. But one thing that I would say is when I started in the industry and back in Morgan Stanley, coming up on 30 years ago, and we started to lecture about options and derivatives, and we started to try to educate people about their use and incorporation for any types of hedging and for portfolio management. I was rather taken aback to learn at that time from somebody who knew the industry well that in polling all of people who ran money and money managers, that it was an appallingly small percentage of the entire universe of people who actually incorporated or used options in any way whatsoever in their fund management. I think the number might have been somewhere along the lines of 10% or so. And I really was shocked to learn that. Well, fast forward, and it's 30 years later, and I would say that number has grown significantly. I don't know what the answer would be today, but clearly those who are conversant with options and with derivatives and ETFs and what have you certainly has to be higher than that number. So we evolve, and to say that a fund manager should now be excused from having any knowledge about volatility products or how they can be used to be incorporated in a portfolio and how they can be used to manage risk is to kind of, say that they shouldn't be evolving with the marketplace. Volatility's become a household word. People understand it a great deal more than they did 10 or 15 years ago. You can't watch CNBC without people talking about VIX and volatility and levels and what have you. Mark writes about it extensively, practically on a daily basis. And so, yes, it's entirely realistic that you should expect from somebody who's going to be in charge of managing your money that he be conversant in the latest products, but in the entire concept of how important volatility is for portfolio management.
And now, when I do say that it is realistic, I don't mean to imply that it will somehow be easy to find someone with the level of knowledge that you require. I mean, I think the truth of the matter really is, if you go to your local branch or whatever large nationwide financial planner, financial advisor chain that's on your block, and you knock on their door and they sit you down, they put you into their spreadsheet that they use for all their clients, and they ask you your risk tolerance, and they break you down stocks, bonds, what have you. That person probably is not going to have a strong working knowledge of what we're talking about here. So you probably have to look a little bit deeper, do a little bit more homework, and probably at the end of the day, perhaps pay a little more for those expertise, because they are relatively rare and relatively specialized. And if you're willing to do that, and I think you should be, because this is your money after all, and you want to have someone who really is prepared and skilled enough to manage it from a risk perspective particularly, then I think you really need to do your homework and find that one needle in a haystack, that one diamond in the rough, that one advisor in your area who has some working knowledge of this, and they could sit down and help you construct a portfolio, perhaps with an overlay, perhaps generating some income, whatever it is you're looking for. And they could have this knowledge of volatility that will help them do that much more effectively. It'll just require a little bit of legwork. Anything to add, Mr. Sebastian?
The part that upsets me is the way the guy phrased the question. Like, you can't expect a guy to actually do his job, can you?
Yeah, that's not what it boils down to.
Yeah, it's like you can't expect a pilot to. The pilot's got to pay attention to the rotors, the engine. You can't expect him to not drink on the job too. I mean, it's just.
How did I know you'd have a colorful analogy in response to this question?
I mean, it's just the most ridiculous question in that it letting these awful financial advisors, who all they do is take these silly financial products, package them, charge you 2%, and say, hey, good luck. Every single one of those, $, $HOLES, should be booted out of the industry.
That's why I wanted to get your opinion on it, because I knew you would not have any strong opinions at all on this subject. All right, good question there, Mr. Aston. I think, yes, do your homework. I'm sure there's some floating around in Brooklyn. If you do a little bit of homework, you can find them. All right, and last up, we have a question probably from one of our hardcore listeners here. He goes by the handle StatArb, and he wants to know, do you think they'll pull all the vol swaps onto CEFs along with the CDSs? And so there's a lot of alphabet soup here. This is ironic timing on this letter or on this email, because just came back from the FIA conference down in Boca, and this was pretty much the talk of the show, everything to do with CEFs and swaps. Of course, CEF, SEF, that stands for Swap Execution Facility, and CDS is, of course, Credit Default Swaps. And if you've been familiar or heard anything at all about all the regulatory reforms going on in Washington these days, in particular with Dodd-Frank, they've mandated that this whole world of over-the-counter swaps start to be migrated onto these quasi-exchanges that they're calling swap execution facilities. But of course, the devil is in the details. How does a firm qualify? What is a swap execution facility? What really is a swap versus a future? These are all the niggling details that are still kind of being worked out. And Dodd-Frank doesn't really answer all those. They kind of just push that onto the regulators and onto the industry to kind of solve it themselves. So they're in the process of doing that. But it's interesting you write this now, StatArb, because I kind of had the same question talking to a lot of people this week about everyone's talking about the credit default swaps. That, of course, is where a lot of the problems started back in 2007, 2008. So that's where a lot of the focus initially has been. But there seems to be some disagreement on once you start rolling on into other products like the vol swaps, like the variance swaps, over who has jurisdiction over them, CFTC versus SEC, or if they're joint, what they're going to do with them, if they're going to be forced onto CEFs or not. There's a lot of that stuff hand-wringing being done. I think at the end of the day, I think the impetus certainly is to push all of this stuff, or at least as much of this stuff as they possibly can, onto these quasi-exchanges / swap execution facilities. That's the impetus of the government. That's why everyone's lining up to become a CEF these days, to get in on that new clearing gold rush. But I don't think vol swaps are going to be in that first wave of things coming over. I think once they get all that stuff worked out and who really regulates these things. I saw some breakdown the other day that said CFTC had broad variance swaps, but SEC had smaller equity. I couldn't really tell what distinction they were making there. So I think there's a lot that still needs to be worked out. But it's a very good question, and I think these things eventually will be migrated onto these CEFs. And that actually is a good thing, particularly for us, a very selfish perspective, a good thing for us here on this show, because we've talked a number of times in our vol review and our crystal ball about getting more transparency into what's going up OTC in the vol and variance swap market, so then we can use that information to inform what we see in the listed markets from a vol perspective. This will make that much easier to accomplish. And in fact, I'm talking to some people now about if they start getting these trades up on their CEFs, that we can then start seeing some of that data. So that indeed will be a good thing down the road for the Volatility Views program. Mark or Don, I know this is a little bit down the rabbit hole. Anything you guys want to add on this one?
No, I'll let it stand at that. I mean, it's going to be interesting to see as to whether or not they're then going to consider that these are indeed exchange-listed products or simply still over-the-counter products, but, transparent or visible. Everybody knows that it's one of the hallmarks of the Volatility Exchange and Volex that we actually have a patent on an exchange-traded, therefore, listed and visible product that settles to realized volatility. So it'll be interesting to see if they attempt to pull some of the over-the-counter swaps onto what would then be considered as potentially a listed market, what kind of a potential conflict there might be there. But it's somewhat down the road, as you say, so we have our eye on it.
To give you a hint of, or some insight into how confusing all this stuff is, as we're recording, I looked into this a little bit before the show to see if I can find a definitive answer, and I came across this Venn diagram, which in and of itself is scintillating, I know. But they have on the one side the CFTC regulated swaps, and they have equity index variance in parentheses broad index. On the right-hand side, they have SEC regulated, and they have equity variance swaps. So I'm not sure really what the distinction between the two is or who has what going on. So I think that's one of the reasons why this stuff really hasn't been worked out yet here, Mr. StatArb, because no one really can determine who is watching what and what each swap actually is. It's a lot of minutia, a lot of regulatory stuff, and a lot of stuff that, quite frankly, I don't think the regulators really have a good handle on, which is why, actually, for the first time I can remember in ages, I've been going to Boca for a long time. It's usually an industry event, a lot of exchanges, brokerages going down there. I saw a ton of trading firms down there for the first time being represented in force. And the reason they're all down there in a panic is because of stuff like this, because the regulators finally have their hands in their business doing some things that they probably should have been doing a long time ago, but they really don't understand how it's done. So these guys who are trading this stuff on a day-to-day basis finally realize they may have to get their hands a little bit dirty in order to make sure the stuff is actually done in a proper fashion. So interesting question, StatArb. Maybe we'll get back to it down a little bit and see what's actually going on with this stuff. That's about all the time we have for the mailbag this week. Thank you to everyone who wrote in a great array of questions this week, as always. And now we're going to keep on rolling to our final segment, the Crystal Ball segment.
And now we take a look at the Crystal Ball.
All right, and welcome to the Crystal Ball. And as we said at the top of the show, this is very interesting times from a volatility perspective. We've been doing this show for about 2 years now, and in all that time, I think I could count on one hand, perhaps on one finger even, the number of times where we've had environments where implied and realized have been within this close of striking distance of each other. And indeed, realized and implied actually can seem like a fairly priced bargain for the first time in a long time. So that makes this a very, very interesting time to be looking forward a little bit into the volatility ether. Mr. Sebastian, perhaps we'll start with you. Now that we're in this very, very interesting period, what are you looking at for the rest of the week into next week?
Oh, I think that you'll see, I don't think the VIX is going to be able to hold 11 handle all next week. So I think you'll see VIX settle somewhere between 12 and a quarter and 12.75. And S&Ps will break their all-time high next week.
There you go, going out on a limb. We should remind our listeners, of course, the settlement is next week for the VIX, so keep an eye on that. It's always a fun process to watch and see where this stuff, where the wheel finally settles at the end of the day there. Good stuff there to keep an eye on for our listeners. Mr. Don, what in the realm of NASDAQ vol and NASDAQ volatility is catching your eye, and are you watching for the coming week?
I'll make a couple of comments, not just on NASDAQ, but on the broad indices in general. We've talked often about the fact that certainly implied volatility, but to some extent realized volatility as well, seems to go in opposite directions from price movement. Often up movement in indices is a kind of a well-ordered climbing a wall of worry and not a lot of precipitous up days, whereas the same isn't always true for the downside, where sometimes the corrections can be rather brutal and happen kind of all at once, thereby increasing volatility. And so there's an awful lot of connection between what your outlook is for the markets themselves in terms of price and therefore predicting volatility. It's interesting to see that historical NASDAQ volatility is virtually identical to S&P volatility for the last 21 days. And of course, the long-term volatility for NASDAQ is somewhat higher, significantly so, than the S&P. So in looking forward, you'd probably have to say that with the two being equal right now, and with the historical proclivity, if you will, for NASDAQ to be more volatile than the S&P, that going forward, if you're making predictions, you probably want to predict greater movement and greater increase in volatility for NASDAQ than you would for the S&P. We'll see how it plays out.
Yeah, Don, the big problem is you've got Apple and Google, which now account for, near 20% of the index collectively, maybe more. And they're moving in opposite directions constantly. It's like, one of my traders said they're conspiring to make the NDX do nothing.
Yeah, well, that's one of the problems because obviously in any index you can have great volatility in individual names, but if they happen to be very strongly negatively correlated and those moves offset each other, that's what we talk about when we do dispersion trades. You can have individual volatility, but if they cancel each other out, there's no movement to the index itself. So that can be an interesting phenomenon to look at. Nonetheless, there are more names in NASDAQ than just the two, although obviously comprise a great percentage of the index. So you'd have to think going forward that you might indeed have the dispersion once again, or the difference between NASDAQ and S&P, and see somewhat higher volatility for the NASDAQ as you would for S&P. If I would make a prediction for a spread type of trade, that's one of the things that I might take a look at. As far as absolute levels of volatility, I think it continues to depend on your predictions for market movement, and I probably tend to agree with Mark that it's not a question of if, but when S&P reaches a new high. It's kind of backed off of that 1565 level today, and I think most people would probably agree with me that when you set new highs, you very rarely tiptoe through it and settle a half a point or a point higher. You usually kind of blow through it. And so what we've had today, I know listeners are listening on Monday, but it's about 2:25 New York time, and we've got a little ways to go, but the indices are down. S&P's at about 1559. It's probably unlikely that it's going to have that big charge and blow through this afternoon. I think that when we finally do set a new high, it'll probably be definitive, and there'll be no doubt about it as to the fact that you're going to be blowing through. If that were to happen, we probably can see VIX levels even lower than they are right now, so something to look for.
Wow.
That'd be an impressive level indeed, and that would certainly be something else to foster some great discussion on an upcoming episode of Volatility Views. Unfortunately, that is all the time we have this week. I, of course, want to one more time. I, of course, want to thank my cohorts here, my partners in crime, good old Don and you, Mr. Mark, for joining me on Vol Views this week. And before we go, as always, I want to check in, see what you guys have cooking in your respective necks of the woods. Starting off with you, Mark, what is cooking in the land of the option pit?
April 20th, New York City. Myself and Sibos Russell Rhodes and Jill Malandrino, we're going to be teaching an all-day class on trading VIX options, VIX futures, and VIX ETNs. You can go to optionpit.com/events. If you are an Option Insider listener and you sign up, I will give you a $200 Option Pit credit for signing up for the class. Pretty awesome.
And how do they do that? Is there a promo code or something they should do, or say just say I heard from it in Options Insider?
Just say you heard from me. Just say you heard from me.
Okay.
Yeah. Just shoot me an email. Say, hey, greasy meatball, yada, yada, yada.
There you go. So that should be the subject line, greasy meatball, yada, yada, yada. And then you'll get your $200 credit.
There you go.
All right. Thank you for that, Mark. And Don, what is cooking over in the land of VolX?
Well, not a whole lot new in terms of developments for the past week. We had a request from somebody from Canada and a researcher. We've added a few more indices that we're now tracking in terms of the Real Vol daily indices. We've got the Toronto index. We've got Bovespa from Brazil. So we continue to respond to the requests of our users who are doing research and asking for perhaps extended calculations, more graphic abilities, and what have you. So if you've got any requests, if you've got anything that you'd like to suggest for the website, anything that you think that would be useful, we try to respond immediately. So feel free to get in touch with us over at the website, and we'll be happy to answer any questions that you may have.
Thank you for that, Mark and Don. And I, of course, want to mention to all of our listeners, we discussed on a previous episode our upcoming Options Insider Unusual Activity Forum. It was scheduled for March 27th. Since we announced that date, we had a lot of people contact us saying, we want to be part of this. What can we do, both on the contributor, on a content, on a registration perspective. So we thought rather than cramming everyone in to a date that was rapidly approaching, we're going to give it a little more time. So we're going to roll it out to May 15th. That is a Wednesday in May. So it gives us 2 extra months to get all of these great speakers who want to be part of it, actually get them time to line up and adjust the content accordingly, and get you guys who are signing up a really great experience. So to everyone who registered, we'll reach out to you and we'll see if that time works for you. If not, we'll be sure to refund you right away. Now, everyone who hasn't registered, maybe because that early time didn't work, this is your chance now to get in on the new show before it fills up there in May. A lot of great people lined up. We're going to be changing the events page on our site very quickly to reflect all the new participants we have on the show, and a lot of great freebies we're giving away with the show as well. It's our mantra here at the Options Insider. We don't really charge for a lot. This is the first time we're ever actually charging for an event, so we want to make sure we give you over-the-top value for your dollar, not just in terms of content, but a lot of great swag, a lot of great freebies, a lot of great services you're going to get for free just for coming to the event, in addition to the floor tour, which is, those things are going the way of the dodo pretty soon. So get in on it while you can. That's May 15th. You can surf on over to theoptionsinsider.com/events to learn more about that and register for yourself. And that's going to do it for the Volatility Views show. And of course, all of us here on the Volatility Views panel want to thank all of you out there in the listening audience for downloading and streaming and subscribing. And of course, for writing in. You guys send in some great questions. So keep it up. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.